Hi, I'm Carlos Lopez, Managing Director of Creative Planning. You probably know what periodic rebalancing of a portfolio means, but do you know what opportunistic rebalancing is and why it's different? Ready to learn more? Let's get started. Before we dive into the topic, let's first understand what generally an investment portfolio is. A portfolio is a collection of financial assets such as stocks, bonds, ETFs, or mutual funds that an individual investor holds for investment purposes. It's built with a specific mix to accommodate investment goals and risk and in a determined asset allocation. Now, investors create portfolios to seek to achieve their investment goals, which may include generating income, preserving capital, or maximizing returns. However, the value of the assets in a portfolio can fluctuate over time, which can lead to a drift from the original asset strategy or asset allocation. This is where portfolio rebalancing comes in. Rebalancing is the process of realigning the portfolio to the original asset allocation mix, which is typically determined based on the investor's risk tolerance and investment objectives. In most cases, investors and some advisors will rebalance their portfolio on a periodic basis, such as annually or semi-annually, to bring the portfolio back in line with the original target allocation. This portfolio sample shows a 70% stock portfolio and 30% bond portfolio set at the beginning of one year, and then shows how when stocks outperformed, the stocks became overweighted within the portfolio. So thus, at the end of the year, the portfolio is subsequently rebalanced back to the original target allocation. This is done because by rebalancing, this may reduce your market risk over time compared to someone who didn't rebalance their portfolio at all and allowed stocks to become overweighted. What's the potential problem with periodic rebalancing? Markets don't work on calendars, so rebalancing based on an annual or semi-annual basis may not make sense and could result in poor outcomes. So now let's talk about opportunistic rebalancing. Opportunistic rebalancing is a proactive approach to portfolio management that takes advantage of market volatility to buy or sell assets in a portfolio. The goal is to maintain the desired asset allocation mix while taking advantage of potential market opportunities. For example, let's take a look at a slide. Let's say an investor has a target asset allocation of 50% stocks and 50% bonds. In the left panel is the periodic rebalancing and what it looks like on an annual basis, as stocks came up fairly quickly in a good market and then it went back down later in the year. The client in this case missed selling and achieving those gains because the gain occurred in the middle of the year. The right panel is again showing the annual rebalancing over a 3-year time period where stocks are more slowly rising. In each year, the rebalancing is occurring too early and moving money out of stocks while the stock market is going up. However, with opportunistic rebalancing, if the stock market experiences a measurable rise, whether quickly or slowly, the value of the stock portion of the portfolio will increase, leading to a deviation from the original asset allocation mix. In this scenario, an opportunistic rebalancer may sell some of the stocks in the portfolio to retain the gains and use the proceeds to purchase bonds in an effort to decrease the stock portion slightly and potentially preserve capital in the future. The opposite can also be true. If the stock market experiences a significant drop, like what we saw in 2022, the value of the stock portion of the portfolio will decline, leading to a deviation from the original asset allocation mix. In this scenario, an opportunistic rebalancer may sell some of the bonds in the portfolio to purchase additional stocks, taking advantage of the market downturn to increase the stock allocation and potentially benefit from the future market growth. The goal of opportunistic rebalancing is a proactive approach to portfolio management that takes advantage of market volatility to buy or sell assets in the portfolio. The goal is to maintain the desired asset allocation mix while also taking advantage of market opportunities. There is no guarantee, of course, that opportunistic rebalancing will achieve its goals, and as with any investment strategy, there is always the risk of loss. Please talk to your advisor about whether or not they're periodically rebalancing or opportunistically rebalancing your portfolio. If you don't have an advisor, please reach out to us here at Creative Planning. We look forward to working with you. Thanks again. See you in the next video.